Welcome to today's webinar on economic conditions in the services sector. I'm Haley Shenander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Joe will be entertaining questions at the end of his presentation. If you have a question, please type it in the chat box on Zoom. We'd love to get your feedback at the end of this presentation as well, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. And with that, I'll turn it over to Joe.
Thank you, Haley. And thank you, everybody in the audience, for joining us this morning. I will be reviewing the results of our annual survey of professional and business services firms. And then I'll be entertaining some questions at the end, as Haley said. Before I go any further, I will just like to give my standard disclaimer that my views are my own and not necessarily those of my employer, the Federal Reserve Bank of Minneapolis, or the Federal Reserve System. Standard disclaimer that we like to give. I'll try and avoid expressing my views generally so that won't really be necessary. But I'd just like folks to keep that in mind in case I do slip an opinion in here or there. So it'll be a brief presentation this morning. I'll be sharing the results of a survey that we just released today. The survey is conducted in partnership with the Minnesota Department of Employment and Economic Development. Many thanks to them for their long-running partnership with us and participation in this survey. It's a survey of a subsector of the subset of the sort of general services sector, which is a very large part of the economy. We're focused on professional services firms and administrative, scientific, and technical services, a few other categories like that. And I'll give a little bit of detail about that sector in a moment before I get into the results of the survey itself. And just so as not to keep you in suspense, the results of the survey are nothing, I would say, too exciting. We asked them what happened over the last year, and they told us that they saw slight to modest growth generally over the last year. Of course, there's a lot of variability in the results, and I'll get into that a little bit. More importantly, maybe more interestingly, I should say, for the audience, we asked them about their outlook for the year ahead. And this is as of mid-year, and their outlook for the year ahead, I would say, is modestly optimistic or moderately optimistic, especially given the growth that we saw over the past year being flat to slight. Their outlook for the year ahead is for an increased rate of growth if you interpret the survey results that way. We also asked some special questions that were of interest to us, given sort of the sort of general interest in the press and in the business world about the usage of artificial intelligence, and also about office space too. The office market, commercial real estate is a hot topic right now, and so we asked firms. These are firms that are heavy users of office space, and we asked them about their usage of office and their plans for the coming year. Generally speaking, they're not expecting a lot of change in their office usage, and that's kind of the sort of brief preview of that result. Before I go any further, just to kind of give you a quick rundown, a lot of folks in the audience may have attended one of these webinars or some of our other presentations before, but for our purposes, I'll be making a lot of references to the region. This survey is regional in nature. It's not a national survey, and it covers firms in the Federal Reserve Bank of Minneapolis's 9th district, or the Federal Reserve's 9th district, which is what the Federal Reserve Bank of Minneapolis covers. And you can see a map of our district here on the screen. We cover the states of Minnesota, North Dakota, South Dakota, Montana, and then we have the northwest portion of Wisconsin and the Upper Peninsula of Michigan. So across this kind of broad, geographically large, but mostly not very densely populated region of the country, I'll talk a little bit about the economy of this part of the country in general, and particularly the role that the services sector plays in it. I just want you to keep that in mind in overviewing those results. That's what I mean when I talk about the region as the Federal Reserve 9th district. So to get into the services sector, who are these firms that we are actually surveying? So like I mentioned, a lot of the economy falls, a lot of economic activity falls under the auspices of services generally, but we're focused on a subset of services firms, and you can see those here. They're broken down by NAICS code. That's North American Industrial Classification System. That's just a way that we have of classifying firms by their lines of business. And you can see that there's sort of two broad categories of firms that we're capturing in the survey. And those are in the sort of professional, scientific, and technical services categories. And I'm not going to go ahead and read through the list of examples that I'm giving you here, but you can take a look at the slide and see examples of them. And then the other is administrative and support services. So firms that provide a lot of services to businesses rather than services to consumers. A lot of times when we think of services, maybe we think of things like travel. We think of things like healthcare or a beauty salon, things of that nature. But we're really talking more about business services in this case. So those are the kind of the two sectors from which we're sampling here. And as far as what they make up as a share of the economy, you can kind of see sort of what they represent in terms of output. So this is just as a share of GDP for the US and for the 9th Federal Reserve District. I mentioned already what the 9th Federal Reserve District constitutes earlier. But you can kind of see what these two sectors make up in terms of their share of output. So GDP is a measure of the output of the economy, and you can see that when you combine these two sectors together, they make up about 13% of output nationally, a little less than a sixth of output, or rather a little more than an eighth. And then in the 9th district, it's a slightly smaller share of output. It's a similar share, but slightly smaller than an eighth of GDP for the 9th district states. If you were to just look at Minnesota, it would actually be a larger share than the national shares. This is for all of those states in the region. Just to kind of keep that in mind for folks in the audience, there are probably a lot of folks from Minnesota in the audience. Within the state of Minnesota, these are a relatively larger portion of the economy. Now, that's just in terms of the value of goods and services produced by this sector. As far as where people are working, you can see it's also a pretty significant share of employment in the economy as well. About 15% of the employment nationally and 11% of employment in the 9th district as of earlier this year. So that's kind of the breakdown in terms of the size of this share of this sector of the economy. It's a significant but not overwhelming share of the economy. But importantly, these are businesses that provide a lot of services to other businesses. So they kind of give you a broader sense from how they're doing of how businesses generally are doing, because their customers are other businesses. So that's kind of an overview, just kind of to sort of level set what we're talking about, and now to get into the survey results. So a quick word about how we conduct this survey. I do want to stress we do a lot of surveys within the Federal Reserve and at the Federal Reserve Bank of Minneapolis. Again, if you've tuned into other webinars that we've done, you've probably seen us present results of other surveys. This survey is one that we do that is really kind of in keeping with the sort of best practices or gold standard of scientific surveying. That is to say, we conducted via a random sample. The sample is stratified by firm size, so it's meant to be kind of a representative sample of these firms. Its firm size in this case being the number of employees that they have, and we try and get that sample stratified and representative of the states, and so that we're getting a proportional representation of the states in our district. We survey about 1,700 firms around the district outside of Minnesota. And I should mention, I mentioned that we do this survey, we conduct this survey in partnership with the Minnesota Department of Employment and Economic Development. And the way that we break that down is DEED conducts the survey in Minnesota, and you can go to their website this morning if you're interested in seeing just the results for Minnesota. They do a separate release. They share their raw data with us, and then we combine those with the survey that we conduct in the other states in the 9th district. And I'm giving you our 9th district level survey results this morning. So this is going to be kind of for the whole 9th district. It's a larger geographic region, a larger economy. Both of them are interesting, though, and I would encourage you, if you're interested in the Minnesota-specific results, to check out DEED's website. And thanks again to them for their partnership. So we survey a broad array of firms. It's conducted via mail as well, so they have to fill out a form and mail it back to us. And this time doing this survey, we got just under 300 responses, which is a decent response rate, given the number of firms that we survey and the number of contacts that end up being old businesses that have gone out of business. It's an issue that we're always having to deal with. So that's kind of an overview of kind of what the survey is. Again, just kind of want to sort of emphasize that these are pretty high quality survey methodology and results that I'm sharing with you this morning. One more quick kind of level setting in terms of who we're surveying. We do a little demographic inquiry about the nature of the ownership of these firms, and you can kind of see that broken down here. A decent share of them, just over a fifth, are woman-owned firms. Just about 10% are minority-owned firms. A slightly larger share are veteran-owned, and then just about 3/5, just over 60%, replied that they are none of the above. So that kind of gives you an idea of what the demographic breakdown of the firms is. And like I said, the size of these businesses run the gamut from very large firms with over 1,000 or even many more employees than that, to small firms that are even, some of them, sole proprietorships that just have one employee or a few employees. And again, that's the sample that we do is kind of stratified by firm size. So by nature, most firms are smaller firms, have fewer employees. Most people work, the largest share of people work in larger firms with more employees. So we get a pretty good representation that way. There's a lot of firms, a lot of them are small firms, and that's sort of by design. It's meant to be representative of the universe of businesses out there. So to get into the results of the survey, like I said, if you, the overall kind of headline summary I would give to these results is it was a steady year this past year. So again, one more thing about the survey to mention is that we conduct this survey in the middle of the year. Like I mentioned, we sent the first round of survey mailing out in May, and we kept it open through the middle of July. And we ask what happened over the previous year. So it's not exactly a clean cutoff in terms of what year we're talking about, because we asked what happened over the previous 12 months. So this goes back into the latter half of 2023 and the first half of 2024. And then we ask them what their expectations are for the 12 months ahead. So it's kind of keep that cutoff point in mind. We're really overlapping 2 calendar years, but it's a 1-year period that we're looking at. So this look back period over the last 12 months, businesses told us that they saw some growth, but relatively mild growth. And the way I'm summarizing this here is what we call a diffusion index. So we asked for a variety of indicators, such as sales or profits, whether that increased for them over the last year, whether it decreased for them, or whether it was unchanged relative to the year earlier. So this is the year-over-year change. And a diffusion index is a way of summarizing these results into a single number, such that any number larger than 50 means that on balance, that indicator expanded over the past year. Any number less than 50 on balance meant it contracted over the last year. The larger share of firms told us that it went down over the past year. So it's just kind of a way of, you put that threshold in the middle, and it kind of gives you a sort of a tipping point sense for growth or contraction over the past year. And you can see that most of these, or a number of these indicators came in right at about that cutoff point. So right at about level. Sales were positive over the past year, just slightly. But again, this is a way of summarizing the results. You can see, again, positive growth in sales, just slightly positive in productivity and employment. Larger increases, not surprisingly, in the prices, given what we know about the inflationary environment right now. So those are in pretty solid expansion territory. Again, not surprising. Labor availability, they told us, got worse, sort of overwhelmingly. So this is a way of summarizing those results, but there's a lot of variability. And I would encourage you, if you're interested in seeing a more detailed breakdown, you can read the article that we just published to the website this morning. Haley posted a link in the chat, and you can kind of see a detailed breakdown. But just to give you an example, so sales revenue, I'm telling you, increased on balance. About 43% of the respondents told us that sales were up over the last year, but 35% of them told us that it was down over the past year. So just because we have it sort of, we're categorizing it as having expanded doesn't mean that's true for everybody. And of course, maybe that's obvious, but just to underscore that there's a lot of variability in these results. And by contrast, when we look at employment expanded over the past year, but more than half of the respondents told us that there was no change in employment over the last year. So they just kept their employment level. Slightly higher share of them, very slightly higher share, told us that they increased employment versus decreased employment. One other thing I want to stress in showing you these first set of results here is we're asking them about what happened at their firms. We're not asking them their perception of what happened in the economy. So we're not asking them, what do you think happened to business activity, or what do you think happened to employment? We're asking them, did you hire more people at your firm? Were you able to hire more people? Is labor availability higher? And you can see, again, large share told us that labor availability got worse. About a third of them told us that labor availability went down, which is actually a relative increase from last year, but on balance, it still went down. So that's kind of an overview of a year ago. Again, I would characterize these results as being slight to moderate increase in economic activity. You can see, of course, the thing that many businesses are most concerned about, profits were down on balance. About 43% of firms told us that their profits were down over the last year. But overall, slight to mild growth over the past year. And you can kind of put this in context if you look at how this survey results have come in over the history of the survey. And I'm just showing you the same data point here, which is that diffusion index. And you can see that solid bar at 50, that cutoff point between expansion and contraction over the last dozen years of this survey. And this is just for sales revenue and employment, kind of two of the things that we're most focused on when we're looking at demand, overall economic activity. And employment, of course, is pretty important. You can see actually last year, they told us that employment at their firms went down on balance, and it rebounded to positive territory over this past year. So they told us on balance that they hired over the last year. Sales, however, relatively dipped, even though they were still in positive expansion territory per the diffusion index this year. They actually went down slightly over the last year. So that's kind of give you a sense of where we're coming in relative to history. Pretty standard relative to history. The employment is coming in slightly weak, but not into really serious, recession or contraction territory, and overall kind of a rebound from the year before. So turning to their expectations for the year ahead. So like I mentioned, we asked them what happened at your business over the last year, and then what do you expect to happen in the year ahead? And what I'm showing you on this chart is the same depiction that I showed you earlier, which is the diffusion index. Again, higher than 50 is expansion, lower than 50 is contraction. But I'm comparing now what their outlook is for 2024, for the rest of 2024 and heading into 2025 versus what their outlook was a year ago. So I was showing you what they told us this year happened over the past year. Now I'm comparing to what their expectations were when we did this survey last year. So just to kind of make that distinction here. And you can see that their outlooks for the year ahead are optimistic. They're expecting a sort of a higher share of them are expecting growth at their firms this year. And they're on balance slightly more optimistic than they were at this time last year when we conducted this survey. So you can see that a large share of them are expecting an increase in their sales revenue over the coming year. About 40% of them, just over 40%, told us they were expecting their sales to increase over the coming year, compared to fewer than a quarter that are expecting their sales to decrease. So that's to kind of give you a little bit more detail on that number. But you can see sort of across the board, while they told us that their profits were down over the past year, and a year ago, they actually expected that to be the case. So their expectations were correct in that regard. They were expecting a reduction in profits on balance over the last year. They're expecting for the coming year profits to be level. So it came in right at 50 on that diffusion index, just under a third in each category. We're expecting profits to increase versus decrease. 37% of them, so slightly more than a third, were expecting no change in profits. So pretty even balance across the board, telling us that they expect their profits to either increase, decrease, or be unchanged. And again, you can see positive outlooks for productivity and employment, some outlook for improvement in labor availability, but it's still expected to go down over the coming year. And the inflation picture is about the same, slightly higher picture, slightly higher expectations, both for their selling prices and for their input costs as well. So that's kind of the sort of the outlook for the year ahead. Again, to kind of contrast with the expectations over time. So this is, again, the sort of history of the results for sales and for employment. And you can see, and this is just their expectations over time. So what they were expecting at any given point in time for a year ahead. And you can see there's sort of a rebound in expectations, as you just saw in the previous chart. If you compare what they were expecting a year ago for employment and sales, a higher share of them are expecting growth, both in their staffing levels and in their revenues for the year ahead. So positive expectations overall, back to where we were a couple of years ago. Kind of a reversal of a slightly declining expectations over the previous 2 years, but pretty standard in keeping with what we usually find in this survey. And you can see that by comparing to where these expectations have tended to come in over the previous 12 years. We also asked them, so everything I've been showing you so far, like I said earlier, was a depiction of their outlooks for their own firms, what they expect for business activity at their places of business. But we also are interested in what they're expecting for overall economic activity. And we asked them about the state level because it's a regional survey. So we're kind of focused more on the state, their state economies. And we just asked them, what are you expecting for the following indicators in your state economy over the coming year? And you can kind of see where those are coming in. I would say, I would, sort of characterize these as being tepid or weak for the year ahead. And slightly less positive outlooks than they were a year ago. So this is, again, I'm comparing their outlook for the year ahead to the outlook that they had 1 year ago. And you can see across the board, they're expecting employment to decline, expecting declines in consumer spending, expecting inflation to kind of to persist. So you can kind of see that across the board. And again, this is their outlook for the state economies. So less optimistic for their states than they are for their own businesses. But of course, they also know their own businesses better than they know everyone else's business. So take that with a grain of salt. Before I get into the Q&A here, I just want to go over the results of a couple of sort of special questions that we asked. We always have the option to add in kind of an ad hoc question on something that we think is interesting, and in discussions with our colleagues at DEED. We thought it would be interesting to ask about usage of AI because there's been a lot of hype about AI in the news and how it's going to change business. And then also about the commercial real estate. For the artificial intelligence question, I would overall characterize their expectations for AI, at least in the coming year. We're asking about a fairly narrow window. So we're not asking them, what do you think is going to happen over the next 20 years? Is this going to change the future of business? But just, do you expect this to have an impact on your business in the coming year? And if so, what impact? And the largest share of them told us that they expected a slightly positive impact. So not no impact whatsoever, but just about a third said that they expected it to be a positive, but only slightly positive impact. And you can see that equal shares, then sort of the next most popular responses were no impact at all or a neutral impact. And so, no impact meaning it's not going to affect my business. Neutral, I would interpret as being on balance, a little good, a little bad, and kind of those two washing out. And then you could combine those together and you get nearly half of respondents telling us that they didn't expect a net impact one way or the other. And then you can kind of see the breakdown, relatively small shares of folks expecting a negative impact, which is maybe a good sign. And then not too many expecting it to be a significantly or very positive or negative impact one way or the other. So again, the largest share of firms not expecting much, but about a third expecting some positive impact from AI over the coming year. It'll be interesting to see if we continue to ask this question in future years, how this might change, because again, this is just for the year ahead. And then obviously another really hot topic right now is the commercial real estate market. A lot of businesses, and especially this is a sector, professional services, business services, that uses a lot of office space. A lot of the employees in these industries are office-based employees. So it was that we thought it would be a good opportunity to ask them what their plans are, if hybrid work is really starting to kind of bind long-term, and whether they're reducing their footprints. And you can see that the results of this were relatively, relatively, I'll just say, not very big news. More than 60% of firms told us that they hadn't reduced their office space. By the way, we ask about office space in our regular questions, but we thought we would ask kind of a more detailed question about why you might be reducing office space if you are. Most of them told us we're not reducing office space. We're not planning to reduce office space in the next year or so. So a slightly smaller share told us that they weren't planning to reduce office space in the year ahead, but still a vast majority telling us they're not planning to reduce their space. Among those that are either have reduced their office space footprint or are planning to do so, you can see, just looking at this chart here, the most commonly provided reasons were that their rents were too high. Surprise, surprise, they want to reduce their rent. Or that there's been some change in staffing, whether that's a permanent shift to hybrid or remote work, or a permanent reduction in their staff such that it would necessitate less square footage of office space for their employees. You can see some of the other categories over there. We have some small portion of people telling us that they're moving to a different location or a smaller space or lower rent space. But again, the overwhelming number of responses came in telling us that there are no plans to reduce space. Again, something that we're going to want to keep an eye on in the future, but at least for the past year and the year ahead, most of these firms are telling us that they're not seeing much movement in these categories. And so with that, we have a few minutes left here, and we can probably go a little bit past 9:30. I want to respect everyone's time. Obviously, if it's a webinar, folks can drop whenever they want to, but I can stay on a few minutes after to answer questions if it's necessary to do so.
Great. Just as a reminder, everyone, if you have questions, please type them in the chat box on Zoom. So let's start with this one. From your GDP breakdown, the services sector is quite a bit larger than the categories you cover in this survey. Why survey only a subset of them?
Yeah, you could see I kind of lumped together a lot of different categories of services into an other services category that was almost a third of GDP. The reason that we focus on this particular sector, Indeed mentions this in their press release. If you want to take a look at I think they did a good job explaining it. These are really firms, like I mentioned earlier, that provide services to other businesses. So we tend to think of a lot of services as being consumer-based services, things that we buy. But these are businesses that are mostly they're providing things like design, consulting, accounting, legal services, a whole gamut of services that they're providing. Their customers that are generally other businesses. So by asking how these firms are doing, we're really getting a pulse on business conditions more broadly by focusing on those. So it's not necessarily our intent to get an overall survey of all businesses and business conditions or the macro economy, but really to get a sense of what's happening to those firms that provide services to other businesses as kind of a read on how their customers are doing as well as themselves.
That makes sense. Someone else was wondering, is it surprising that more firms aren't cutting their office space footprints given the rise in remote work?
So that's an interesting one. And unfortunately on the survey, there's only so much space on the form. So we can't really interrogate them about why they answered a question the way that they did. We only know that they checked the box that they did, and we can't see inside their heads and know why they answered the questions the way they did. But a couple of things I'll say. Number one, a lot of these businesses, like I mentioned earlier, are small businesses. So to have a large share of them telling us that they're not cutting their office space footprint. Well, maybe their office footprint is already not that large to begin with. So that might be part of it. But the other thing is that a lot of the businesses that responded to the survey told us that they're seeing growth in their sales, that they're increasing their employment. In fact, a lot of them in comments have offered that they can't hire enough people, right? So their problem isn't necessarily that they have too much space relative to people. It's actually that they have too few people. So if that's your situation, you probably don't necessarily want to reduce your office footprint. But of course, this is different for everybody. We know that there are in the broader office market, there are other considerations, especially in downtown core business areas. And so I'm not trying to, it's certainly not our intention to downplay the significance of these changes that are happening and that have been happening since the pandemic. It's just to say that when we asked this particular subset of firms over the last year and for the year ahead, they're not changing much. And there's probably a lot of reasons for that.
And in a similar vein, someone was also wondering if there's any information on the change from working from home to the move back to the office that has been helping small businesses that need that help and to improve their real estate outlooks.
Well, I don't know about the real estate outlooks. I would actually turn that question around on you, Haley, since I know you've done, and I don't mean to put you on the spot, but I know you've done a little bit of work on hybrid and remote work. Whether I'd just be curious to see whether you have any thoughts on that one.
I don't, because I've mostly been looking at, the trends over the last couple of years. And
Yeah.
recently, Minnesota does have the highest rate of remote work out of all Midwestern states. So it does seem like it's sticking around quite a bit. But the latest data is through 2023. We don't know exactly what 2024 has brought when it comes to return to office. So not a huge amount of insight I can provide on like the real estate outlook and things like that. But it is definitely more popular here and does seem to have more staying power.
Yeah. Yeah, and all I would say, I guess, in addition to that, I mean, I kind of said a few things already that I thought were, that I think were maybe related to that question, but just to say that, there's a lot of these smaller firms are focused more on hiring right now than they are on reducing their office footprint, and so I think that's kind of, that's part of the reason why we're seeing what we're seeing.
For sure. And it looks like we have time for one more question. Someone was wondering, can you explain why employment levels remain static while labor availability has dropped significantly?
So yeah, I mean, I would say, there's sort of the question was, why is it that we're seeing labor availability difficult and employment relatively flat? I don't think those two things are inconsistent because, we're asking them not necessarily about their hiring intentions, but about whether or not they increased their workforce. So it might be the case that a lot of these firms would like to hire more than they are. And so the net effect, because they're maybe wanting to hire, but labor availability is still challenging, is that they can't actually grow their staffs as much as they'd like. So I don't think those two things are as inconsistent as they might seem at first. But yeah, at first glance, you might say, "Oh, that's weird. Labor availability is down, but employment isn't changing." I think that's why. I think that probably the desire to hire is greater than, there's still some mismatch between supply and demand.
Yep, great. Thanks, Joe. So that's going to be our last question for today. Thanks, everyone, so much for joining us. And please join us for our next virtual event, Regional Economic Conditions General Business, on Tuesday, August 20th. More information will be in our follow-up email to this event. And with that, I hope everyone has a great day.
Thank you.